Many traders are staring at their screens right now, confused how silver collapsed so fast overnight. Only a day ago, prices hovered near $75, then suddenly 70.5 appeared like a warning. The move felt violent, sudden, and personal, shaking confidence even among experienced market participants. But this drop is not about silver becoming weak or fundamentally broken. The real explanation sits behind the scenes, where structure matters more than emotion. Markets don't just move on news, they move on timing, rules, and calendar pressure. The final trading days of the year are uniquely distorted and misleading. Liquidity dries up, desks are understaffed, and trades become mechanical rather than thoughtful. This environment exaggerates every move, especially in volatile assets like silver. For institutions, December 31st isn't symbolic, it's a hard deadline. Balance sheets are frozen, capital requirements calculated, and risk exposure suddenly matters intensely. Volatile positions make balance sheets look dangerous under regulatory scrutiny. So banks don't debate fundamentals. They reduce exposure immediately. They sell what rules require them to sell, not what logic suggests. That's why this drop feels aggressive and emotionless at the same time. It isn't a shift in belief, it's forced behavior. When large orders hit thin markets, prices move far more than normal. A routine sell order suddenly becomes a cascading price event. That's how silver plunged from 75 towards 70.5 so quickly. Demand didn't vanish. Paper contracts simply flooded the market. You can observe this same behavior happening in gold simultaneously. Gold didn't lose credibility, it slid because of identical balance sheet pressures. Silver just reacts harder because it's smaller and inherently more volatile. When gold sneezes, silver historically catches something much worse. That relationship has existed for decades and remains unchanged. Importantly, this type of selling has a clear expiration date. Once the year turns, regulatory pressure disappears almost instantly. There's no longer incentive to sit in cash just to appear safe. Historically, that's why early January often brings sharp rebounds. Selling happens for compliance. Buying returns when compliance no longer matters. Another overlooked factor is the sudden surge in dollar demand. Institutions raise cash simultaneously, pushing the dollar temporarily higher. A stronger dollar automatically pressures commodities priced in dollars. This doesn't signal economic strength, only a short-term liquidity scramble. Once that scramble fades, dollar strength typically reverses. Now look beneath paper markets, where physical silver tells a different story. Physical silver is not behaving like a market in panic. Dealers aren't dumping inventory, and premiums haven't collapsed. In some cases, premiums have actually widened. That divergence tells you futures prices may be misleading. Paper markets reflect forced selling. Physical markets reflect real scarcity. When these disagree, paper markets are usually the unreliable side. From an industrial perspective, lower prices aren't frightening. They're attractive. Manufacturers see lower input costs, not collapsing demand. Orders don't get cancelled, they often get accelerated. That behavior creates a natural floor under price. Real users step in long before fundamentals actually break. This is why calling this the end of a bull market feels premature. For silver to collapse long-term, demand must fall or supply must surge. Neither of those conditions exists today. Industrial demand remains steady across energy, technology, and medical sectors. Supply remains constrained and slow to respond. Silver continues being consumed, not stockpiled excessively. One liquidity-driven event doesn't change that reality. Emotionally, this is the hardest moment for investors. Seeing red numbers triggers fear, even without selling. But if you didn't sell at 75 or 70.5, nothing changed. You still own the same ounces as before. Only the quote on a screen moved, not intrinsic utility. Markets specialize in testing conviction before rewarding patience. They shake confidence right before conditions quietly improve. Forced selling transfers assets from weak hands to stronger ones. That's how long-term trends survive volatility. As the new year begins, fresh capital typically returns. Pensions, allocations, and redeployed funds re-enter markets. Combine that with normal liquidity and pressure disappears quickly. I'm not predicting prices, only describing historical behavior. The biggest mistake now is confusing mechanics with fundamentals. This drop wasn't caused by collapsing demand or excess supply. It was driven by rules, timing, and thin liquidity. Those forces are temporary by nature. Volatility isn't a failure. It's the cost of owning something important. Panic always appears near the worst possible moment. Understanding why moves happen matters more than reacting emotionally.